Welcome back to the deep dive. Today, we're tackling something that, let's be honest, most of us dread. Taxes. Specifically, taxes on your stock market activities.
It's that topic, isn't it? That spreadsheet monster lurking in the corner.
Exactly. We've all been there, just staring at transaction lists, feeling totally lost. Actually, our source material today, it kicks off with the author, a trader themselves, talking about this exact thing, trying desperately to get straight answers from CAs, from brokers.
And just hitting a wall of jargon, right?
Yeah, pretty much. More confusion.
It's such a common problem. So many people in the markets, just like the author, they get intimidated by how complex it all seems. But here's the thing, and this is why we're doing this deep dive.
It's crucial.
It's absolutely crucial. Understanding these rules isn't just like good financial hygiene. It's essential to avoid getting into real trouble with the tax department.
Couldn't agree more. So our mission today is simple. Cut through that complexity. We want to turn that fear into, confidence. Explain everything you really need to know about market taxation, specifically here in India.
Exactly. And believe me, the need for this is huge. The source module we're using, it mentioned the previous blog post they did on this.
Yeah.
Over 2,000 questions on it.
Wow. 2,000.
Yeah. That tells you everything about how much people, like you listening, need this clarity.
Okay, so where are we getting our info today? We're drawing from a really fantastic, comprehensive module. It's called Markets and Taxation from Zero the Varsity.
A great resource.
It is. And it's written from a trader's perspective, which promises a practical, sort of simplified guide. We're going to walk you through the basics of income tax first. Then the really critical part, how to classify your market activity. Are you an investor? A trader? Maybe both.
And the specific rules for each, yeah. Plus audit stuff, and finally navigating those ITR forms.
It's going to be packed, but incredibly useful. So before we jump into the market stuff, let's just ground ourselves. Why do we even pay income tax? What's the point, fundamentally, here in India?
That's the right place to start. Basically, income tax is collected by the government of India. It's all laid out in the Income Tax Act of 1961.
Okay.
Think of it as your contribution to funding everything the government provides. Essential public services.
Like hospitals, roads.
Exactly. Hospitals, schools, national defense, infrastructure projects like roads, bridges. It's what keeps the country running, really.
And who actually has to pay? Is it everyone earning anything?
Well, in theory, anyone earning above a certain minimum amount, the basic exemption slab is required to pay. But here's a pretty startling fact from our source, looking at 2015 data.
Go on.
Only about 2.9% of India's population were actually paying income tax then.
Just under 3%. Seriously.
Yeah. Compare that to, say, the U.S., where it's over 45%. It's a massive difference. Now, part of that is income levels, obviously, but a big chunk is also just a lack of a deeply ingrained tax culture here.
That's a really stark contrast. Definitely food for thought. Okay, something that always confuses people, me included, is the difference between a financial year and an assessment year, FYAY. Can you break that down?
It does trip people up, but it's actually quite logical once you see it. The financial year, or FYY, that's simply the period when you earn the income.
Okay, the earning period.
Right. It always runs from April 1st to March 31st.
Always.
April to March.
Got it.
The assessment year, or AY, is just the year after the financial year. It's the year when you file your tax return and the tax department assesses the income you earned in that previous FY.
Okay, so income earned in, say, FY 2014-15.
That's filed and assessed in AY 2015-16. Simple as that. Earned in the FY, file in the AY.
Makes sense. Now, how do these income tax slabs work generally? Could you give us a feel for it, maybe using that 2014-15 example from the source, without getting lost in the weeds?
Sure. Think of it like steps or tiers. Your income gets sliced up, and different slices get taxed at different rates. So using that FY 14-15 example, for individuals under 60, the first chunk up to, say, 2.5 lakhs.
That was tax-free.
Totally tax-free, NIL tax. Then the next slice, maybe from 2.5 lakhs up to 5 lakhs, that got taxed at a lower rate, like 10%.
Okay.
Then as your income goes higher, the next slice gets taxed at 20%, and anything above a certain high threshold, maybe euros lakhs, falls into the top bracket, say 30%. It's progressive.
And these thresholds, these slabs, they change based on your age too, right?
Exactly. That's a key point. The basic amount that's tax-free is higher for senior citizens, those between 60 and 80.
Right.
It's even higher for super senior citizens who are 80 plus. So generally, the older you are, the more income you can earn before you start paying tax.
Okay. So let's say my employer deducts TDS tax deducted at source and gives me that Form 16 at the end of the year. Am I done then? Is that it?
No, not even close, unfortunately. That Form 16, it only covers the tax deducted on your salary income.
Right, just the job income.
Just the job income. You, as the taxpayer, are still responsible for declaring all your other income sources.
Like what?
Things like interest earned from your bank accounts, any capital gains you made from selling stocks or funds, maybe rental income if you own property. All of it needs to be added up.
And then I file a return covering everything.
Precisely. You have to file a comprehensive return. And, don't think for a second anything can be hidden these days. The income tax department's systems are incredibly sophisticated now.
I can see everything.
Pretty much. They can access bank details, track all your stock market transactions through your PAN card. It's all linked up. Hiding income is a really bad idea.
Okay, message received. Let's move to the market stuff. Probably the most critical first step for anyone trading or investing. How do you classify yourself? Are you an investor, a trader, or maybe a bit of both? This seems foundational.
It absolutely is. Everything else flows from this classification. But here's where it gets interesting, maybe a bit tricky. The CBDT, the Central Board of Direct Taxes, they issued a circular back in 2007 trying to define this.
And what did it say?
Well, it basically said an investor buys shares mainly for dividends and long-term appreciation. A trader buys and sells more frequently, aiming for profit from price movements.
That sounds a little vague. Intent.
Exactly.
Yeah.
The word intent is the problem. It's subjective. And frankly, most people buying stocks hope the price goes up, right?
Yeah, of course.
So this vagueness gives the assessing income tax officer, the AO, a lot of power to interpret your activity. It's not always clear-cut.
Okay, so given that gray area, how does the IT department broadly categorize the money you make or lose in the market?
They break it down into 4 main income categories you absolutely need to understand. First one, long-term capital gain, LTCG.
Long-term capital gain.
Yeah.
Sounds straightforward.
It is. It's the profit you make when you sell stocks or equity mutual funds that you've held for more than 1 year.
Held for over a year. Okay. Now, is there any real upside here? Any big advantage for the patient long-term holder?
Oh, absolutely. And this is honestly one of the most powerful tax benefits in the Indian system for equity shares and equity mutual funds.
Yeah.
If you sell them on a recognized stock exchange, like the NSE or BSE,
Yeah.
and the STT securities transaction tax has been paid,
Which it usually is on exchange trade.
right, then the tax on that long-term capital gain is 0.
Wait, say that again? 0%.
0%. Nil, nothing.
That's incredible. So holding equity for over a year literally means tax-free profit provided you meet those conditions.
Precisely. Patience pays off massively. Imagine you bought, say, 1 lakh worth of Infosys shares 10 years ago. You sell them today for 1 crore.
Big win.
Huge win. Profit of 99 lakhs. And the tax you pay on that, 0.
Wow. That is a massive incentive for long-term equity investing.
It really is. Now, there's a catch for off-market transactions shares not sold on a recognized exchange. For those, LTCG is taxed at 20% for unlisted shares or 10% for listed shares sold off-market. So, big difference there.
Okay, got it. Exchange-traded equity LTCG is the golden ticket. What's the second category?
Second is short-term capital gain, or STCG. This is probably more common for many people.
Short-term. So held for less than a year.
Exactly. Profit from stocks or equity MS sold within 1 year of buying them, but held for more than just 1 day.
And the tax rate here?
If it's on a recognized exchange and STT is paid, it's a flat 15% tax.
15%. Okay. So back to your Infosys example. If I bought for 1 lakh, sold 10 days later for 1.2 lakhs.
That's a $20,000 gain.
Right. Tax is 15% of that.
Yep. 3,000 tax.
Yeah.
Simple flat rate, much clearer than slabs. Unless it's an off-market STCG. If you sell shares off exchange within a year, that gain gets added to your regular income, like salary, interest, etc., and taxed at your normal income tax slab rate.
Ah, so that could easily be 20% or 30% depending on your total income.
Exactly. Much higher, potentially. Okay, third category, speculative business income.
Speculative? Sounds like gambling.
Kind of. It specifically refers to intraday equity trading, buying and selling the same stock on the same day without any intention of actually taking delivery of the shares.
Okay, pure day trading. And the tax rate, is it fixed like STCG?
No, there's no fixed rate here. It's treated just like any other business income.
Meaning?
Meaning it gets added to all your other income, salary, rent, interest, whatever. And that total income is then taxed according to your individual slab rates.
So if I make $100,000 from intraday trading and my salary is $400,000.
Your total taxable income becomes $500,000. You pay tax on that whole amount based on the slab rates for your 100 lakhs.
Got it. It just bumps up your total income. What's the fourth and final category?
Fourth is non-speculative business income. This covers trading in futures and options, or F&O, whether it's equity F&O, commodity F&O, or currency F&O.
Hang on, why is F&O considered non-speculative, but intraday equity is speculative? That seems counterintuitive to me. F&O feels pretty speculative.
I know, it sounds odd, right? It boils down to the legal definition. F&O contracts, at least in theory, can be used for hedging existing positions, or they could potentially result in the delivery of the underlying asset, even though most F&O in India is cash settled.
Ah, okay. So it's about the potential for delivery or hedging, even if that's not usually how people trade them.
Exactly. Whereas with intraday equity, the definition explicitly states there's no intention of delivery from the very beginning. It's purely about the price difference within the day.
Okay, that distinction makes a bit more sense now. And how is this non-speculative F&O income taxed?
Same as speculative income. It's added to your other income sources,
Yeah.
salary, etc., and taxed as per your applicable slab rate.
So both intraday and F&O profits just increase your total taxable income.
Correct. Let's take an example from the source. Imagine someone runs a hotel business, earning 20 lakhs a year, and they also trade F&O, making a profit of 5 lakhs.
Okay.
Their total income is 25 lakhs. That whole amount gets taxed according to the slabs. So that F&O profit could easily end up being taxed at the highest rate, say 30%, just because their total income is high.
Right. That makes the decision of how you classify yourself really, really important. Which brings up a question. Why would anyone choose to classify their trading as business income if it might push them into a higher tax bracket, unlike the flat 15% STCG or 0% LTCG? What's the angle there?
That is the million-dollar question, isn't it? Because, yes, while it can mean higher taxes, there are some significant advantages to declaring trading as a business.
Okay, let's hear them. What are the pros?
Pro number one. It could actually mean lower tax potential in some cases.
How?
Well, if your total income, including your trading profits, is still below the basic tax-free limit, say 2.5 lakhs, then you pay zero tax. Or if it keeps you below hero FIGs, you might stay in that lower 10% slab.
Yeah.
So for smaller traders or those with lower overall income, it can be beneficial.
Okay, makes sense for lower income levels. What else?
Pro number two, and this is a big one,
Yeah.
you get to claim business expenses.
Ah, this is where it gets really interesting. Unlike capital gains, where you can basically only net off brokerage, maybe.
Exactly. Under capital gains, you can't claim much, but if it's business income, you can deduct all legitimate expenses related to that trading business.
Like what specifically?
Oh, lots of things. All your brokerage charges, STT, which is huge.
Yeah.
Remember, STT cannot be claimed against capital gains, but can be claimed as a business expense.
That alone is a major difference.
Huge. Then there's internet bills, phone bills proportionate to your trading use, of course,
Yeah.
depreciation on your computer, your screens, even a portion of your rent if you have a dedicated home office space for trading. Salaries if you employ someone to help, costs of research reports, financial newspapers or books, advisory fees, all deductible. It can significantly reduce your taxable profit.
That's a massive advantage for active traders. Okay, what else? Any other pros?
Yes, number three, offsetting losses. If you have non-speculative business losses, like from F&O,
Yeah.
you can set those losses off against almost any other income you have in the same year, except salary.
Any income except salary. So rental income, bank interest, even capital gains.
Yep, F&O loss can wipe out those other incomes, reducing your overall tax bill for the year.
That's powerful loss utilization. And the fourth pro.
Loss carry forward. If you can't fully offset your losses in the current year, you can carry them forward. Non-speculative F&O losses can be carried forward for up to 8 years to offset against future non-speculative business gains.
8 years. That's quite a long time.
It is. Speculative losses from intraday equity can also be carried forward, but only for 4 years, and crucially, only against future speculative gains. So, more restrictive.
Okay, those are some compelling reasons to choose the business income route. But it can't be all sunshine and roses. What are the downsides? The cons?
You're absolutely right. There are definite cons to consider. The biggest one, as we touched on, is potentially higher taxes. If your trading profits, added to your other income, push you into the 20%, or worse, the 30% tax slab, you'll pay more tax than the flat 15% CCG.
Right, the slab rate hurts at higher income levels. What else?
The complexity of ITR forms. If you declare business income, you can't use the simple ITR1 or ITR2. You'll likely need to file ITR-4 or maybe ITR-4S.
And those are more complicated.
Definitely. They require more details, schedules for business income, maybe even a balance sheet and P&L. Most people find they need help from a chartered accountant, a CA, to file these correctly, which adds cost.
Okay, complex forms, potential CA fees, anything else?
Yes, the possibility of audit requirements. You might need to maintain detailed books of accounts and get them audited by a CA if your turnover crosses a certain threshold, or if your declared profit is below a certain percentage of turnover. We'll get into those specifics later.
Audit. Yeah, that sounds like something most people want to avoid if possible. Okay, so weighing these pros and cons. What does this all mean practically? Can you be like an investor for some stocks and a trader for others, or is it an all or nothing choice?
That's a great practical question. And the good news is, yes, you absolutely can be both simultaneously. The CBDT circular actually clarifies this.
Okay, so a hybrid approach is possible.
Totally possible. You can have a portfolio of stocks you intend to hold long-term, that's your investment portfolio, aiming for dividends and that sweet 0% LTCG. And at the same time, you can have a separate portfolio, or just engage in activities like F&O or intraday, which you classify as trading, or business income.
But you need to keep them separate. Critically important. You need to clearly demarcate in your records which transactions are investments and which are trades. If you're doing F&O or intraday, you have to classify that as business income anyway. But that doesn't stop you from showing your long-term delivery-based holdings as investments to claim capital gains benefits.
Consistency is key then.
Absolutely. Our source stresses this. Be consistent year after year in how you classify similar activities. Don't just flip-flop based on whether you made a profit or loss that year to get the best tax outcome. The tax department looks for consistency.
Okay, let's focus on the investor side now. We've said an investor holds delivery equity for the long term, primarily. And while the IT department doesn't give a hard number for frequency, our source suggests very frequent delivery trades might be better off classified as business income anyway.
That's a good summary. So digging into LTCG for investors again, we know it's 0% for listed equity MFs held over a year if STT paid on exchange. Off market, it's 10% listed or 20% unlisted. Now, what about not equity, like debt mutual funds?
Right. What's the rule for debt funds held long term? For debt funds or other non-equity assets, if you hold them for more than 3 years, the game is considered LTCG. And it's taxed at 20%, and this is crucial with the benefit of indexation.
Indexation. You mentioned that briefly. It sounded important. Can you unpack that? What is indexation and why does it matter so much, especially for things like debt funds?
Indexation is honestly a fantastic concept the government provides. It's basically an acknowledgement that inflation eats away at the value of your money over time.
So a rupee today isn't worth the same as a rupee 10 years ago.
Exactly. So indexation allows you to adjust your original purchase cost upwards to account for that inflation. The government publishes a cost inflation index, or CII, number for each financial year.
Okay, so how does it work in practice?
Let's use that debt fund example from the source. Say you bought a debt fund for 1 lakh back in 2005. The CII for that year was 497. You sell it in 2015 for 3 lakhs. The CII for 2015 was 2024.
Okay, so simple gain is 2 lakhs. Tax at 20% would be 40,000.
Right, without indexation. But with indexation, you first calculate the index cost of acquisition. You take your original cost, about 1 lakh, and multiply it by the ratio of the CII in the year of sale to the CII in the year of purchase.
So 100,000 times 124 divided by 497.
Precisely, which comes out to roughly 206,036. That's your new inflation-adjusted cost base.
Okay, so the taxable gain isn't 2 lakhs anymore.
Correct. Your taxable LTCG is now your sale price, 300,000, minus your indexed cost, 206,036, which is only 93,964.
Much lower.
Much lower. And the tax on this at 20% is just 18,792.
Wow. That's less than half the tax compared to no indexation. So for debt funds where returns might just keep pace with inflation sometimes.
Indexation can mean you pay very little or even no tax because your real gain after accounting for inflation is much smaller. It's a huge benefit for long-term debt investors.
That is genuinely powerful and easy to overlook. Okay, what about STCG for investors, short-term gains?
Right. For equity and equity MFs held between 1 day and 1 year, sold on exchange with STT paid, it's that flat 15% tax.
Flat 15%. Simple enough.
For non-equity, like debt funds, held for less than 3 years, the gain is STCG. And this STCT is simply added to your total income and taxed at your individual slab rate.
So if I'm in the 30% bracket, I pay 30% tax on my short-term debt fund gains.
Exactly. It just gets clubbed with your salary, interest, etc.
This days of holding thing seems incredibly critical then. Selling a stock at 360 days versus 366 days could mean the difference between 15% tax and 0% tax.
Absolutely massive difference. A few days can change your tax liability completely.
Yeah.
It requires careful tracking.
Yeah.
And when you've bought the same stock multiple times at different dates,
Yeah, how do they figure out which shares you sold?
the income tax department mandates the FIFO method. First in, first out.
First in, first out. Okay.
Yeah.
Example.
Sure. Let's say you bought 100 shares of Reliance in April 2014. Then you bought another 50 shares in June 2014. Now in May 2015, you decide to sell 120 shares. Using FIFO, the first 100 shares you sell are deemed to be the ones you bought first, back in April 2014. Since you held those for over a year, April 14 to May 15, that gain is LTCG, tax-free.
Right.
The remaining 20 shares you sold are deemed to be part of the batch you bought in June 2014. Since you held those for less than a year, June 14 to May 15, that gain is STCG, taxed at 15%.
Got it. The oldest shares go out first for tax calculation. Very clear. Now, what about expenses? Can investors claim anything against capital gains? And what's the deal with advanced tax?
Good questions. For expenses, STT, the securities transaction tax, usually 0.1% on delivery trades, unfortunately, cannot be directly added to your cost or deducted from your sale price for capital gains calculation.
So STT is just a cost you bear?
Effectively, yes, when calculating capital gains.
Yeah.
However, other transaction costs like brokerage, exchange transaction charges, SEVI turnover fees, stamp duty, GST on brokerage, those can be added to your cost of acquisition or deducted from your sale consideration.
Okay, so brokerage and other statutory charges reduce your taxable gain, but STT doesn't.
Correct. Now, advanced tax. If you anticipate having taxable capital gains during the year, especially STCG, which is taxed at 15%, you are technically required to pay advanced tax on it.
In installments.
Yes, the rules generally suggest paying a portion by mid-September, more by mid-December, and the full estimated amount by mid-March of the financial year.
But estimating future capital gains seems really hard. Markets fluctuate.
It's notoriously difficult. So the practical advice our source gives, and what most people do, is pay advance tax based on the gains you've actually realized up to that point. Calculate the tax on gains booked by Sep 15th, pay that. Then calculate additional tax on gains booked between Sep 15th and December 15th, pay that, and so on.
And if you overestimate and overpay?
You'll get a refund when you file your return. The IT department is generally quite efficient with refunds these days, so it's better to pay based on realized gains than risk penalties for underpayment.
Okay, makes sense. One last thing for investors. What if things go wrong? What if you don't have gains, but net losses? How are capital losses treated?
It's also very important. Let's talk short-term capital losses,
Yeah.
STCL first. These are actually quite useful.
Oh, how so?
STCL can be set off against any capital gains in the same year, both short-term gains, STCG, and long-term gains, LTCG.
Okay, so STCL reduces both types of gains.
Yes. And if you still have leftover STCL after setting off against gains in the same year, you can carry it forward for up to 8 assessment years.
And offset it against future gains.
Yes, in future years, carried forward STCL can be set off against future STCG or future LTCG. Very flexible.
That's good to know. What about long-term capital losses, LTCL, from selling equity held over a year at a loss?
LTCL from equity where STT is paid.
Yeah.
That's basically considered a dead loss.
Dead loss, meaning
Meaning you cannot set it off against any income, not even STCG, and you cannot carry it forward.
why is that?
The logic is, since the corresponding long-term capital gain, LTCG, is exempt from tax, 0%, the government doesn't allow you to claim a deduction or carry forward the loss either. It cancels out.
Okay, so LTCL from listed equity is basically useless for tax purposes. Good to know. STCL is much more valuable if you have losses.
Precisely.
So we've navigated the investor's tax world. Now let's shift focus back to the active trader, the person whose market activity is treated as a business. We know there's no fixed tax rate for speculative intraday equity or non-speculative F&O income. It just gets added to everything else and taxed per slab. Can you walk us through that calculation again, maybe with a clear example showing how different income streams add up?
Absolutely. Let's build a slightly more complex picture. Imagine someone has salary income of 10 lakhs, short-term capital gains, STCG, from delivery trades of 1 lakh, F&O trading profits, non-speculative business, of 1 lakh, and intraday equity profits, speculative business of 1 lakh.
Okay, a mix of everything. How does the tax work?
Right. First, you combine the normal income and the business income. So salary, 10 euro sell plus F&O profit plus intraday profit, 1 LO, plus intraday profit, OALO, 12 lakhs total.
Okay, 12.
This 12 lakhs is taxed according to the regular income tax slabs. For someone under 60, the tax on euro lakhs, using FY 115 slabs for consistency, would be around, say, 1,085,000.
Got it. Tax calculated on the combined amount using slabs.
Then you deal with the capital gains separately. The STCG of 1 lakh is taxed at that flat 15% rate.
So 15,000 tax on the SDCG.
Exactly. So the total tax liability for this person for the year would be 1,085,000 from salary plus business income plus 15,000 from STCG upon 2,000,000.
That breaks it down really clearly. Business income merges with salary for slab rates. Capital gains are taxed separately at their specific rates.
Precisely. You have to keep the streams distinct for calculation.
Now, what if trading business isn't profitable? We touched on losses, but can you detail the rules again for managing and carrying forward business losses, especially if you file on time?
Yes. Filing on time is crucial to carry forward losses. Let's break it down by type again. Speculative losses from intraday equity. These can be carried forward for 4 assessment years.
4 years.
But here's the strict rule. They can only be set off against future speculative gains. You can't use an old intraday loss to offset F&O profits later.
Okay. Speculative loss only offsets future speculative gain. Got it. What about non-speculative losses, like from F&O?
These are more flexible initially.
Yeah.
In the same year you incur the loss, you can set it off against any other income source you have.
Except salary.
Except salary. So rental income, interest income, even capital gains and F&O loss can reduce those in the current year.
That's useful.
Very. Now, if there's still some non-speculative loss left over after doing that, that remaining loss can be carried forward for 8 assessment years.
8 years for F&O losses, longer than intraday.
Yes, but the carried forward non-speculative loss can only be set off against future non-speculative business gains in those subsequent 8 years. You can't use an old F&O loss to offset future salary or capital gains.
Ah, okay. So same year offsetting is broad, except salary, but carry forward offsetting is restricted to the same type of business income, non-speculative versus non-speculative.
You've got it. That's the key distinction.
This brings up a really critical planning point. You mentioned speculative loss can't offset non-speculative gain. What about the other way around? Can a speculative gain be offset by a non-speculative loss?
Yes, and this is a very important nuance. While speculative loss is quarantined, speculative gain is not. So if you have a non-speculative loss from F&O, say, and a speculative gain from intraday.
The F&O loss can wipe out the intraday gain.
Absolutely. In the same year. So if you lost 1 lakh in F&O but made 1 lakh in intraday, your net business income could be 0. You wouldn't pay tax on the intraday gain because the F&O loss absorbed it.
Wow. Okay, so strategically, having F&O losses is better for offsetting than having intraday losses because they can absorb intraday gains, whereas intraday losses can only absorb future intraday gains. That's a subtle but potentially huge difference for mixed traders.
It really is. Understanding that interaction is key for tax planning if you trade both.
Makes sense. What about this term tax loss harvesting? I hear traders talk about it, especially near the end of the financial year. What's that about?
Tax loss harvesting is a perfectly legitimate strategy. It basically means if you have some positions currently sitting at an unrealized loss towards the end of March,
Yeah.
you intentionally sell them before March 31st to book or realize that loss within the current financial year.
Why would you do that?
To use that realized loss to offset other taxable gains you've made during the year, like STCG or even F&O profits if it's an F&O loss. This reduces your overall tax liability for the current year.
Ah, so you crystallize the loss now to save tax now.
Exactly. And then if you still believe in that stock or position long term, you can just buy it back immediately, perhaps the next day in the new financial year. You've booked the loss for tax purposes, but you're back in the position.
Yep.
It essentially defers the tax outgo.
Clever. Okay, one more classification question. BTST. Buy today, sell tomorrow. Where does that fit? You buy today, it shows in your DV out tomorrow, but you sell it tomorrow itself, so you never really took full delivery in the traditional sense. Speculative or non-speculative?
Yeah, BTST is a bit of a gray area, and there's debate. Because you don't square off the position on the same day, it's technically not intraday speculative.
Right.
And importantly, STT is charged on BTST trades at the higher delivery rate, not the lower intraday rate.
Oh, interesting. So the tax treatment hints at delivery.
Exactly. So our source and many experts lean towards classifying BTST as either non-speculative business income, like F&O, or potentially even STTCG if you do it very infrequently and treat it like a short-term investment.
But if you do BTST constantly,
If it's very frequent, forming a pattern of business, then classifying it as non-speculative business income is probably the safer, more conservative approach to avoid potential disputes with the tax officer. Calling frequent BTST ACTG might be pushing it.
okay, non-speculative business income seems like the safer default for regular BTST traders.
Yeah.
And advanced tax for business income, same deadlines as capital gains. Sep
Well-
15, December 15, March 15.
Yes, the deadlines are exactly the same. 30% of your estimated annual tax by September 15th, 60% by December 15th, and the full 100% by March 15th.
And still hard to predict for traders.
Even harder, arguably. Business income can fluctuate wildly. So again, the best practice is to estimate the tax based on the business income you've actually earned up to each deadline. Calculate profit till Sep 15, estimate tax, pay 30% of that. Calculate cumulative profit till December 15, estimate total tax, pay up to 60% of that total, and so on.
Pay as you earn, basically.
Exactly. Pay based on actual earned income. Overpaid, get a refund. Underpaid significantly might attract interest penalties. So better to pay diligently based on what you've booked.
We keep coming back to one of the big perks of business income expenses. Can you just quickly list again those key deductible costs traders should absolutely be tracking?
Definitely. It's worth repeating because it saves real money.
Go for it.
Okay. All trading charges brokerage, STT, the big one, exchange fees, SEBI fees, stamp duty, GST, proportionate costs for .internet, phone bills, depreciation on computers, laptops, monitors, printers used for trading, a portion of your home rent or maintenance if you have a dedicated trading space, salaries paid to anyone assisting you with trading or accounting, fees paid for financial advisors or research services, costs of relevant books, magazines, financial newspapers, data subscriptions, basically any expense incurred wholly and exclusively for the purpose of your trading business. Keep bills for everything.
That's a comprehensive list. Tracking those diligently can make a huge difference to the bottom line. Okay, let's get into the real nuts and bolts now, the technical stuff like turnover audits and financial statements. First up, turnover. You mentioned this is only relevant for business income, not capital gains, right? And it's just to figure out if you need an audit, not how much tax you pay.
Correct on both counts. Turnover calculation is purely an audit threshold test for business income. It doesn't directly impact your tax liability, which is based on your actual profit or loss.
So how do you calculate this turnover for trading according to the ICAI guidelines our source uses?
It depends on the type of trading. For delivery-based trades, if you're classifying them as business income, which is less common, usually they are capital gains, then turnover is simply the total sales value.
Okay, total sales value for delivery as business.
For speculative trades, meaning intraday equity, turnover is the absolute sum of all the differences, positive or negative.
Absolute sum, meaning you ignore the plus or minus sign.
Exactly. If you make a 2,000 profit on one trade and a €1,000 loss on another, you add 2,000 plus euros on 3,000. That's your turnover for those two trades. You add up the value of the outcome of every trade, ignoring whether it was a profit or loss.
Got it. Add the absolute values. What about non-speculative trades like F&O?
For F&O, it's a bit more complex. Turnover is the sum of 1, the absolute value of all the favorable and unfavorable differences, similar to intraday. 2, any premium you received when you sold options. And 3, if you did any reverse trades to close positions, the difference on those also counts.
Okay, that F&O calculation sounds like something you definitely need your broker's report for, or a good spreadsheet.
Absolutely. You need detailed records. And speaking of calculation, I hear there are different ways brokers might present this, like strip-wise versus trade-wise. What's the difference, and which one should we aim for?
Yes, that's an important practical point. Script-wise turnover looks at each stock or contract you traded, aggregates all the buy-sell differences for that specific script over the period, and then takes the absolute value of that net difference.
Okay, nets out per script first.
Trade-wise turnover, on the other hand, does what we just described for intraday. It sums the absolute profit or loss for every single individual trade you made throughout the year across all scripts.
Which one is preferred by the tax authorities?
Our source, in general CA consensus, is that the trade-wise method is the most compliant and accurate interpretation of the ICAI guidelines. It captures the total value of transactions more fully.
But harder to calculate. Often, yes. Most brokers' standard reports might give script-wise summaries. Getting a true trade-wise absolute profit-loss sum might require downloading all trades into Excel and calculating it manually, or using specialized reporting tools some platforms offer, but it's the gold standard for compliance.
Good to know. Aim for trade-wise, if possible. Okay, so once you've calculated this turnover, when does it actually trigger a tax audit requirement for your trading business?
There are two main triggers, based on the law as per our source's context. First, if your total business turnover for the financial year crosses 1 crore.
1 crore turnover. Straightforward threshold.
Second, and this affects many more traders, especially those starting out or having a tough year, it's under Section 44AD of the Income Tax Act.
Section 44AD, what does that say?
It basically says if your business turnover is less than 1 crore, but your net profit from that business is less than 8% of your turnover, you might need an audit.
Less than 8% profit on turnover, so if you make a loss.
If you make a loss, your profit is definitely less than 8%. It's negative. So yes, incurring a loss while having turnover below €1 crore generally triggers the audit requirement under Section 44AD.
Wow, okay, so a loss almost guarantees an audit unless. Is there any escape clause?
Yes, there's a crucial exception highlighted in the source. An audit under Section 44AD, the less than 8% profit rule, is not required if your total taxable income for the year, from all sources combined, is below the basic exemption limit.
Meaning if your total income is less than 2.5 lakhs, so you wouldn't owe any tax anyway.
Exactly. If your final tax liability for the year is 0, you don't need an audit just because your trading profit was below 8% or negative. That's a huge relief for small traders who might have a small loss, but no other significant income.
That is a vital exception. Good to flag. Our source also mentioned that Section 44AD can be tough on retail traders compared to traditional businesses.
Yes, because in trading, especially F&O, turnover, calculated as the sum of absolute differences, can balloon very quickly even with small capital, and achieving an 8% net profit on that potentially huge notional turnover can be extremely difficult. A traditional shop might have 50 lakhs turnover and make 5 lakhs profit, 10%, easily clearing the 8%. A trader might have €2 crore turnover just from churning, but only make 2 lakhs profit, 1%, technically falling under the audit rule if not for other exceptions.
That makes sense. The turnover calculation method for trading inflates the number relative to profit potential. Okay, and if you do declare trading as business income, you need to maintain certain financial statements, right? What are they?
Yes, if it's business income, you need the basics. A balance sheet, a profit and loss P&L statement, and proper books of accounts.
Balance sheet. That sounds intimidating.
It doesn't have to be, especially for an individual trader. It's just a snapshot of your financial position on the last day of the financial year, March 31st. What do you own? Assets like cash and bank, demat holdings value, computer, minus what do you owe? Liabilities like loans. The difference is your net worth. You can usually piece this together from bank statements, loan statements, and your demat statement.
Okay, a snapshot of assets and liabilities. What about the P&L?
The profit and loss statement tells the story of how your net worth changed during the financial year. It summarizes your income, revenue, and your expenses for that year. For a trader, revenue would include business income from trading, maybe some capital gains if you have both classifications, interest income, etc., but not salary. Salary goes directly to total income calculation. Expenses are all those deductible things we listed. Brokerage, SDT, internet depreciation, rent portion, fees, etc.
So P&L explains the profit or loss for the year.
Exactly. It shows how you got from the beginning balance sheet to the ending balance sheet effectively.
And books of accounts. What does that mean for a simple trader?
For most individual traders who might only have trading income and maybe a salary, the books can be fairly simple. Our source suggests primarily two things. A bank book, which could just be your detailed bank statement, ideally downloaded into Excel, where you can add notes explaining each transaction and keeping the corresponding bills or invoices. And a trading book, which is essentially the collection of reports your broker provides, your P&L statement, your ledger showing cash movements, and crucially, all your digital contract notes for every trade. Keep these records organized.
Okay, bank book and trading book from the broker. That sounds manageable. Right, we've covered a mountain of information. Now for the final stretch. Actually dealing with the income tax return, the ITR forms. First off, I hear people mix up paying income tax and filing income tax returns. Are they different things?
Yes, they are definitely different, and it's a really important distinction. Paying tax is the act of actually remitting the money to the government. This happens through things like TDS cut by your employer, or you paying advanced tax installments or paying self-assessment tax before filing.
Okay, paying is sending the money.
Filing the return, on the other hand, is the formal mandatory declaration you make to the income tax department. using a specific ITR form. In this form, you tell them about all your income from all sources for the financial year, calculate your total tax liability, detail the taxes you've already paid, like TDS and advance tax, and figure out if you owe more tax or are due a refund.
And you have to file even if tax was already deducted, or even if you made a loss.
Absolutely. Filing is mandatory if your gross total income exceeds the basic exemption limit. And even if it doesn't, or if you made a loss, you must file the return if you want to carry forward that loss to future years. Filing the return is the only way to claim loss carry forward. You also need to file if you want to claim a refund.
Okay, filing is the official report card to the taxman and crucial for losses and refunds. So how do you pick the right ITR form if you're involved in the markets? There seem to be quite a few.
The form depends entirely on the types of income you have. Let's break down the relevant ones. ITR 1, Sahaj. This is the simplest form. It's only for resident individuals with total income up to 50 lakhs from salary, one house property, and interest income. Crucially, NO capital gains, and no business profession income. So useless for almost all market participants, except maybe someone with only bank interest besides salary.
Okay, ITR 1 is out for traders and most investors. What's next?
ITR 2, this is for individuals and HUFs who have income from salary, house property, interest, etc., and capital gains, but no business or profession income.
So ITR 2 is the form for people who are purely investors, long-term holdings, short-term holdings, maybe some debt funds, but no intraday or F&O.
Exactly. If you only have salary, other income, and capital gains, LTCG, STCG, ITR 2 is your form. It's more detailed than ITR 1 because you need schedules to report the capital gains calculations.
Okay, ITR 2 for investors. What if you trade F&O or intraday?
Then you move up to ITR 4. Sugam initially, but let's clarify this later. Or rather, the main ITR 3 for individuals, HUFs having income from profits and gains of business or profession, or ITR 4 for presumptive income. Let's focus on ITR 3 and 4. ITR 3 is the comprehensive form for individuals, HUFs, who have income from a business or profession calculated normally, not presumptive. It includes fields for salary, house property, capital gains, and business profession income, including speculative and non-speculative.
So if I'm an active trader, intraday or F&O, or I'm both an investor and a trader, I likely need ITR 3.
Yes, ITR 3 is generally the correct form if you have business income from trading, calculated normally, requiring P&L balance sheet potentially, alongside other income like salary or capital gains. Our source mentioned ITR 4. Let's clarify the distinction because names change. Pre-2017, ITR 4 was the main business form. Now, ITR 3 is for normal business income, and ITR 4, Sugam, is specifically for the presumptive taxation scheme.
Okay, ITR 3 for regular business income trader Shibrins. What's this ITR 4, Sugam, and the presumptive scheme then? Sounds simpler.
It is simpler. Designed to reduce compliance burden for small businesses. That's the advantage. If you opt for the presumptive scheme under Section 44AD for eligible businesses, or 44AE for transporters, you can use ITR 4, Sugam.
And the benefit is?
You don't need to maintain detailed books of accounts, and you don't need to get your accounts audited, even if your profit is below that 8% threshold we discussed, as long as turnover is below the limit, typically to core now for presumptive. But let's stick to the EuroCR context of this source for consistency here.
No books, no audit. Sounds great. How does it work?
Instead of calculating your actual profit, you just declare a presumptive income, which is deemed to be a certain percentage of your total turnover. For most businesses under 44AD, this is 8% of your turnover, or 6% if turnover received digitally.
So you calculate your trading turnover using those methods we discussed.
Let's say your F&O turnover is 4 lakhs.
Okay.
You just declare 8% of that, which is 32,000, as your presumptive business income. This 32,000 is then added to your other income, like salary, and taxed at your slab rate.
Even if my actual F&O trading resulted in a loss, say I lost 25,000.
Yes. Even if you had an actual loss of 25,000, if you opt for the presumptive scheme with ITR 4, Sugam, you still declare a profit of 32,000, 8% of turnover.
That seems like a raw deal if you lost money. Why would anyone do that?
It's a cost-benefit analysis. Remember, if you declare the actual loss of 25,000, your profit is less than 8%, which normally triggers an audit requirement, unless your total income is below taxable limits. Getting an audit done by a CA can cost, say, 15,000 or more.
Right.
By using ITR 4, Sugam, and declaring the presumptive profit of 32,000, you avoid the audit hassle and cost. The extra tax you might pay on that deemed $32,000 profit, maybe $46,400 if you're in the 20% lab, could be significantly less than the CA's audit fee.
Okay. So you pay a bit more tax maybe, but save a lot on compliance costs and headaches. It's a trade-off.
Exactly. It's designed for small taxpayers to simplify compliance. But there are catches with ITR4 SUGAM for traders. You cannot use ITR4 SUGAM if you have speculative business income, intraday equity. It's only for non-speculative presumptive income. You also cannot use it if you want to carry forward losses from previous years or set off current year losses. And technically, reporting capital gains alongside presumptive income can be complex or disallowed in some interpretations.
So ITR4 SUGAM is really only suitable for someone with only F&O trading, treated presumptively, maybe some salary interest, no intraday, no losses to carry forward, and probably no significant capital gains.
That's a good summary. For many active traders dealing with both F&O, intraday, capital gains, and potentially losses, the presumptive scheme via ITR4, SUGAM, is often not suitable, and they need to file the more complex ITR3, maintain books, and potentially get audited if thresholds are met.
Okay, that clarifies the ITR form landscape significantly. ITR2 for investors, ITR3 for most comprehensive trader hybrids, ITR4, SUGAM, as a simplified option for specific presumptive cases only.
You got it.
Before we wrap up, any final quick tips or FAQs from the source material that listeners should keep in mind?
Yes, a few key practical points. E-filing is mandatory for most taxpayers now. Use the official portal, incometax.gov.in. Note, the portal name has updated since the source material's time.
Okay, file online.
ITR forms are generally annexureless, meaning you don't attach documents like bank statements or contract notes when you file, unless it's an audit case where the audit report is attached. But you must keep all supporting documents safely for several years in case the department asks for them later during scrutiny.
Keep your records, even if you don't submit them initially.
File your return, even if you have a loss. Cannot stress this enough if you want to carry it forward.
Right. Loss carry forward needs timely filing.
Know the due dates.
Yeah.
Generally, July 31st for individuals, HUFs whose accounts don't need auditing, and October 31st, note, often extended, but this is the typical date now, for those requiring an audit. Late filing attracts penalties and restricts law carry forward.
Mark the calendar. July 31st for most.
If you miss the deadline, you can file a belated return, usually until December 31st of the assessment year, but with penalties. However, a belated return cannot be revised. Only an original return filed on or before the due date can be revised later if you discover a genuine mistake.
So, file on time for maximum flexibility.
Absolutely.
Wow. Well, this has been an incredibly comprehensive deep dive. We've gone from the basics of why tax exists through classifying yourself, the nuances of LTCG, STCG, business income, expenses, losses, turnover, audits, right down to the specific ITR forms. I genuinely feel like we've helped demystify a really intimidating topic.
I hope so. The aim was really to replace that fear of the tax man with understanding and confidence. Because honestly, financial discipline is the bedrock of building wealth long term. And that discipline absolutely starts with being compliant and informed about your tax obligations.
Especially now, you mentioned the systems are so integrated. Trying to fly under the radar just isn't a smart strategy anymore.
Not at all. Transparency is key. Understanding the rules allows you to comply correctly, but also to plan smartly using the deductions, offsets, and classifications legally available to you.
Which connects back to that bigger idea. This isn't just about ticking a compliance box. Understanding your taxes is actually about optimizing your whole financial journey, making sure your hard-earned money is working efficiently for you. It gives you control.
Well said. It's about taking ownership. So perhaps a final thought for everyone listening. Don't just see tax filing as a chore. See it as an annual financial health checkup. It forces you to understand where your money came from, where it went, and how efficiently you manage it from a tax perspective. Mastering this isn't just about saving tax. It's about becoming a more informed, more disciplined, and ultimately more successful participant in the markets.
A powerful way to frame it. We really hope this deep dive has empowered you. Use this knowledge, keep good records, and please, if your situation is complex, don't hesitate to consult a qualified chartered accountant. Keep learning, stay informed. Thanks for joining us on the deep dive.